If you're 65 or older in Canada, the government can get its hand in your pocket twice. Not just through regular tax, through clawbacks. And in one overlapping area, that can mean an extra 30% tax drag on the next dollar you earn. Scary part is a lot of people don't even realize it because it's not their typical tax rate. So let's walk through two big considerations, then I'll show you a resource that we use with clients that can be a real eye-opener. Because the squeeze often starts earlier than people realize. Your age credit will start disappearing first. Then OAS starts getting clawed back too. And when those overlap, that's where retirement income can get hit a lot harder than people expect. A lot of retirees think, well, I know my income tax bracket, and so I know generally what I'm dealing with. Not necessarily. Because after 65, it's not always about your tax bracket. Sometimes it's about what starts quietly disappearing in the background. And that's the part that people don't always see coming. So let's throw a chart up on the screen. And just to be clear, this is a first blush planning consideration, not a rule book. Sometimes the right move still triggers more tax, and that's fine. The goal here is not perfection. The goal is moving forward with your eyes open. Let's set the scene. Here you'll see the 2026 tax brackets for Alberta, which show you the different tax rates for different levels of income, or your marginal tax rate. This is the rate that each additional dollar will get taxed at. The red line shows you the actual percentage that you'll pay to Revenue Canada, otherwise known as your average tax rate. Simply your total tax bill in any given year divided by your entire taxable income. These are mostly understood. Everyone knows the more you make, the higher tax rate you'll be subject to. What's less understood are what considerations come next. Unfortunately, as you can imagine, with all the credits and income testing and the income tax convoluted mess, it's never this easy. With many of our families we work with, there are two more hidden considerations that we always like to be mindful of when we're talking about target income levels. And that's where we have to build off of this chart. So let's start with the age credit. Once you're 65, you may be able to claim the age amount, which helps reduce your overall tax bill. Sounds good. Then, very politely, the government starts taking that back. Starts just north of $46,000 of income. And as your income rises, that credit gets clawed back at 15% of every dollar above that 46,000 number. And by the time you're around 107,000, it's all gone. That's why many think of this as almost a hidden tax. You're not writing a separate check for it. You're just losing a credit that you thought you were eligible for come tax time each year. Then we add on to that old age security. This is one more people have at least heard about or are conscious about. Clawback for old age security starts around $95,000 of income. And it also gets clawed back at that same 15% rate for income above that level. Then it keeps going until it's fully clawed back at just under $155,000. And this is where people usually go, hang on, I'm already paying tax. Now I'm losing my benefit too? Yes, that is exactly what's happening. Now, it's hard not to notice that those two overlap. And that right there is the most painful income range. You've got age credit being clawed back at 15%, OAS being clawed back at 15%. That's an extra 30% of effective tax drag. Not total tax, but an extra 30%, meaning that spike where you see age credit and OAS clawback stacked together, that's an effective 60% tax. That's what we call the income danger zone. And that's where most people look at their tax brackets and say, okay, I can live with that. But what they don't see is the stuff quietly vanishing behind the scenes that are adding to those costs. Same dollar, two different clawbacks. Now, for couples, this matters even more. Because the question in retirement is not just how much income do we have, it's also whose tax return is it landing on? If too much taxable income ends up on one return, and the other spouse still has room on theirs, you can create more tax drag than you need to. And that's one reason that income splitting matters. Not because it solves everything, not because every situation can be fixed perfectly, but because spreading the income across the two returns can sometimes keep one spouse out of the ugliest part of these clawback ranges. And if you want to go deeper on that, we've got a full video talking about income splitting. We'll link it down below. Another thing people should keep in mind, when the first spouse passes away, a lot of the same household income may now be reported on one return instead of two. So even if the assets haven't changed all that much, the surviving spouse can still end up with a lot less after tax. Why? Because one return can get pushed higher into those brackets, further into those clawbacks, and further into these income zones where the credits and benefits start disappearing. This isn't a tax issue for today, but it can become a survivor income issue later. If you see the storm coming, you can at least plan around it. Maybe bring an umbrella. Maybe you smooth out withdrawals. Maybe you split income. Maybe you decide that a higher tax year is still worth it for decisions in life that spreadsheets just can't answer. And that's totally fine. Again, the goal is not to avoid every tax trigger forever. It's simply to stop being blindsided by them. If you want help looking at your own retirement income plan, reach out. We'd be happy to have a conversation. Because the thresholds matter, but how they apply to your situation matters even more. I'm Preston Pellegrini. Thanks for stopping by.